Good evening, one and all. Welcome on this Sunday evening. I'm sure you'll enjoy studying Sundays also. So, I welcome all of you all to a very fascinating topic. And I'm sure by now you all are getting into the depth of this subject, this topic in particular. And as we are progressing lecture by lecture, you all are gaining the confidence, and now I can even say to some extent the expertise that is required for a vast topic like this. See, I'll again tell you, this is the most important topic for a professional who is practicing as a tax consultant or as a tax litigator, because the maximum professional avenues that you get in income tax are, you can say, arising out of this topic. There are other topics also, but you can say this is one of that topic, which is the major professional opportunity creator topic. And that is why it is also having a very big dominant role in your exams, both at the inter and at the final level. Plus also, the importance of this topic is that this topic paves way for even further many more topics. Like at finals, you will be studying assessment of different entities, which includes partnership firms, trust, companies. You will be studying different types of special taxation provisions like taxation of non-residents. So all these will have some base coming from this topic. So this topic is directly as well as indirectly very important for your profession and also for your exams. So let me then now, as our custom is, take up your queries first. So yes, very good evening, Pragya, Almas, Soumya. So I have a query by Astha. She's saying, sir, in insurance premium, it is written we have to deduct premium payable if following mercantile system of accounting. Sir, it will be mentioned, or we have always to include premium payable as a deduction. So Astha, is it that you are indirectly asking that whether we have to assume that it is mercantile, and that is why we have to always assume that it is eligible? The answer is yes. Please understand. See, when you are doing accounting also follows fundamental accounting assumptions, right? And one of the fundamental accounting assumptions is that the accounts are prepared on mercantile system. And once you are making that assumption in accounting, if you remember, I had mentioned on day one that every head has different method of accounting suggested by the law. Now for PGBP, that is business head, and also for other sources head, the law says you can either follow cash basis or you can follow mercantile basis, and you have a choice. But which choice you will take, that depends upon the method of accounting commonly adopted. Now, if you are adopting mercantile system, so even income tax computation is on due basis, that is mercantile basis. And if nothing is mentioned in the sum, which is your main question, now you asked it in particular relating to insurance premium, it is applicable to all. So wherever nothing is mentioned, in that particular case, we are presuming that it is mercantile, and also the same method is adopted in income tax. So in short, you should claim that particular expense following our four golden principles. One, is it related to business? Yes. Again, students, please understand. See, insurance premium is a generic cost or is a common expense, which may be even for business related assets, or it may be for other assets, or even for your personal life. Now, until and unless anything is specifically mentioned in the sum, that what this insurance premium deals with, what the salary expense deals with, what the electricity expense deals with. See, these can be even your personal, but until and unless anything is mentioned contrary, you have to presume in the sum that these are your business expenses. So out of four, our first condition gets satisfied. It is related to business. Second, it is current year. Again, assuming that you are following mercantile, and it is also adopted in income tax as per the option. Third, it is pertaining to current year and it is revenue in nature. And fourth, it is not an offense. This obviously is applicable in majority expenses. So you have to take the deduction of all these expenses like salary, like insurance, like rent, like electricity charges. All these are taken because they are fulfilling our four assumptions. I hope Astha I could answer your question. Fine. Yes, second question by Astha is, sir, what is the meaning of this line in section 35? It does not include expenditure incurred in acquisition of rights in or arising out of scientific research. Sir, here it includes expenses like paperwork, etc. Okay. See, firstly, what do you mean by expenses incurred in acquisition of rights? So see, if you are doing a scientific research, what is a scientific research? It is R&D. If you invent, if you there is a eureka and you come up with a new technology or something which is like now today's buzzword is AI. So somebody developed this concept. Now, when you are developing a new concept, you will get it patented so that nobody else can use it without your permission. Now, when you are getting it patented, it is leading to creation of an asset. That is what is expenditure is incurred in acquisition of rights in or arising out of scientific research. Correct. So you're asking whether it will include paperwork and etc. So yeah, it will include all expenses that are required to get that particular invention patented. That is what is rights expenditure incurred in acquisition of rights. I hope I answered you. Asta has a follow-up question. Sir, it means arrears of insurance premium is not taken. Okay, first let us understand, students, what are arrears. See, arrears means what? Arrears are not outstanding. Many times we misunderstand the term arrears to mean outstanding expenses. Sorry, arrears are not outstanding. Then what are arrears? Understand this. Arrears mean that whenever you are having any expense, understand this, you are having any expense, and in that particular case, that expense is increased retrospectively. So there is accumulation of expense because some expenses increase retrospectively, like generally it happens in case of government employees. You are a government employee. Now government sets up commission called as pay commission. So you have the 7th pay commission, you have the 8th pay commission. These are a committees, group of people who will study on a particular issue and give recommendations to the government on the basis of which government takes decision. Now, these commissions will do all the research relating to what is the present inflation, etc., etc., and they will inform the government that okay, for this particular grade of employee, this should be the salary package. For this grade of employee, this should be the salary package. Now, generally, whenever they are suggesting this, definitely the salary package is higher than what is presently going on. Now, when the government decides to implement this, it is a gap of 3-4 years by the time this research happened, the reports came, the government took a decision. Now it is a choice of the government to implement this new package either from the upcoming year or to make it retrospectively from past 2 or 3 or 4 years. So let us say today the government decides to increase the salary or any component of salary, like commonly you will hear in news, the government decides to increase the DA of the employees by 2%. Now, they also take a call that whether they want to increase it retrospectively. So let us say they have taken a call that they will increase it retrospectively from the financial year 23-24. Now, we are present in financial year 25-26. Now, if they are taking a call that we will increase your DA or any component of salary by a particular percentage retrospectively from 23-24, it means the 2 financial year which are already completed, 23-24, 24-25, you will also get some extra salary, extra DA for those past 2 years. This has accumulated today after the government has taken this decision. This accumulated amount is the arrears. I hope I have answered your question, Astha. Now, generally, Astha, I do not find arrears of premium. You have given example of arrears of insurance premium. Generally, I haven't seen arrears of insurance premium. Generally, it happens in case of rent, it happens in case of salary, and mainly it is related to government because many times whenever the government takes a call, they take it retrospect. So Priyanshi is saying, sir, arrear means spending expenses can be of current year or past year. So yes, Priyanshi. So now I hope you understood what I said. So arrears are technically expenses pertaining to past year. Now, if I have to answer a question in general, that whether expenses on arrears can be taken as deduction in the current year, the general answer is yes, even though they are pertaining to past period, for the simple reason, if I've taken the decision today that I will give you some extra increase in rent, extra increase in salary retrospectively from past 2 years, in those past 2 years, nobody knew that that expense would be there. So today, if I have taken a call, I will book it as expense in the current year itself because the decision is taken today. Fine. Is this clear to all students? Anybody having any doubts, queries, questions on this, please feel free to ask. Or for that matter, any other question relating to PGBP, relating to whatever we have studied, or relating to if there is anything which you have studied till now from module and you have a query. Students, I'm waiting for your inputs. Once you all are through, we will proceed with the next part. All clear? Excellent. So, recap so that once we are repeating it again and again, it is also getting more clearer, more consolidated in your minds. So we are discussing PGBP provisions so that now you can take a call that from your accounting P&L to your PGBP head, what are the items that you will add or less? Now, for deciding what items you'll be add or less, you have to first simply check, okay, this expense or income is there in P&L. Fine, it is there in the sum. Is it covered in PGBP as per the PGBP provisions? If the answer is yes, it is covered in PGBP and the amount is also same. So it is there in P&L also. It will be covered in PGBP also. It means both books will be having same figures, same items. You do nothing while solving the sum. No add, no less. Why? Because it is there in accounting P&L also. It is allowed in PGBP also. It is taxable in PGBP also. It means both set of accounting have the same effect. So we do nothing. When do we add or less? When accounting P&L is showing either on the credit side some income or on the debit side some expense, but your application of PGB provisions, what we have been studying, suggests that this item of expense or income either does not comes in PGBP at all, or it comes in PGBP but with a different amount, like depreciation. It is there in accounts also, it will come in PGBP also, but the amounts are different. So whatever it is, either it does not comes in PGBP at all, or it is covered in PGP but with a different amount. In that case, both books are having a difference. Whenever both books are having a difference, we have to either add or we have to subtract that particular difference so that we can reach from one profit to the other profit. So if your starting point, obviously here it will be always accounting P&L profit because that is the starting point. So from there, by doing the adjustments for the differences, you will reach to your PGBP income. I hope this is clear to all. So now when we are applying PGP provisions, now parallelly we will think of how this has to be affected in the reconciliation statement. Today, we'll start some practical aspects also. We'll go to some particular sections in detail from the module so that we are parallelly doing both. But before that, let me take you to the revision. While revising, we will add a few more points in whatever we have kept pending in the past lectures. So slowly and steadily, we are consolidating the topic. So we are now on the stage of applying PGBP provisions. In PGB provisions, you have provisions for the debit side items, you have provisions for the credit side items. For credit side, broadly, you have two sections, 28 and 41. 28 deals with all business receipts, either direct or indirect. And 41 is dealing with refund or reimbursement of past year's expenses, losses, which were allowed as deduction. So these are past year expenses. These are past year losses, which you had taken as deduction in PGBP. Obviously, when you get the deduction in PGBP, that is decided by the debit side provisions, which is point number 2A and B. So as per point number 2A and B, these expenses which are pertaining of some earlier period were shown as expense or loss, that is they were allowed as deduction in PGB. Now in the current year, these are refunded back to you, these are reimbursed to you. Like you incurred some loss on fire in the financial year 23-24, you showed it as a loss. In this year, you got some insurance claim. So now that insurance claim has to be treated somewhere. Now, how it will be treated, that depends upon whether you are allowed deduction of that insurance loss. So generally, we apply the 4 golden rules for deciding whether any deduction is allowed or not. So whether that insurance loss is related to business, yes, it is of my business goods. 2, is it of current year? Yes, that year it was current year. 3, is it revenue? Yes, because they are goods, they are not assets. 4, is it an offense? Answer is no. Once all these 4 conditions are satisfied in that financial year 22-23, I showed the loss for fire. Similarly, I showed the loss for bad debts. So all these are examples of losses which you have booked, which you have claimed as deduction in any of the earlier previous year. Now in the current year, this amount is getting reimbursed to you, like bad debts are getting recovered, or you are receiving insurance claim, or for that matter, in some past period, you had paid some tax. Now that tax is refunded because you have by mistakenly paid more. Now, when these past expenses are refunded back to you, returned back to you, you have to do a contra entry. If in that period you have shown it as debit, in the language of accounts, we'll call it as debit. In the language of PGP, we'll say you have taken deduction. So if in that period you have taken deduction, now you'll have to show it as a income. So technically it is not income, but it is a reversal of your past debit. So what was earlier claimed as deduction, and if it is now returned back to you, so you have to reverse it. So you will book it as your PGBP income. I hope this is clear about 41. Good. Perfect. I'm reading this name for the first time. Okay, fine. Now, students, I had kept this section pending, 43CA. Now, let me start with this section today. I had purposefully kept it pending because it was more of theoretical. But now, since other sections are clearer, let me take this section. What does section 43CA deals with? Firstly, let me tell you, this section is again repeated in the form of section 50C, which we will study under the head of capital gains. Now, what is this 43CA dealing with? So let us first understand this 43CA is about whom. When you are preparing P&L balance sheet of a builder, that is a person who is engaged in the business of either sale of land after making plots, or either in the business of constructing and selling flats, shops, etc. Now, in that particular person's case, you are showing sales. What is the sale? It is the sale of land, sale of any constructed property. Now, these are regular revenue sales for that builder because he or she is in that particular business. Now, 43CA is not talking about what are your receipts or not. That already 28 has told you. So this is the sales which you are showing here. Sale of land, sale of all these constructed portion as per section 28. So as per 28, we consider business receipts, and this is my business receipt if I'm a builder developer. Now, what is 43CA talking about? 43CA is talking about valuation. Now, a parallel section, what we are going to study now in 43CA is copy paste repeated in 50C again. So what we are going to study about valuation is also applicable to 50C. Now it is valuation of what? Valuation of sale of land or building. Now, when it will be 43CA and when it will be 50C, we can just understand it, and it is very simple. When this land and building is your stock in trade, that is, you are in the business of selling land or building, obviously, then the income is reported under the head PGBP. and it will be section 43C. But when the same land or building is your capital asset, like for you and me, we are not builder or developers, but we also are having some asset in the form of some plot of land or some flat or shop or go down, that is some constructed property. And we may also sell it in some year. In that particular case, the income would be covered under the head capital gain, because in that case, selling this is not our business. We are not builder developers. So for us, it is a sale of capital asset. So the subject is same. The subject matter is land or building. What we have done, the transaction is also same. We have sold this land or building, but in different capacities, either as a builder developer where this land building is appearing as my stock in trade. So this is obviously business head income, or in the capacity as an investor, as an asset holder where this land or building is appearing as my asset. So when I'm selling this asset, it is my capital gain income. So the subject matter is same, the transaction is same, only the nature of my holding will decide whether it will be a PGBP income or whether it is a capital gain income. Whatever it is done. So the head is now not a point. We are not discussing whether it is PGBP or it is capital gain. Now that we understand, and it is very basic and simple. However, whatever head it is, the question is when you have to compute your profit in case of PGBP, the PGBP income, or in case of 50C, that is capital gain, the capital gain or loss, you need to decide two things, the sale price and the expense. 43CA and section 50C both are dealing with the sale value that you have to consider either in PGBP or in CG. Now, what should be the value? So here the amount which I have to consider, let me call it as X. This amount is decided by 43CA. We are talking about PGBP head. Same amount, same thing is discussed in 50C when it is capital gain head. So what should be the sale value taken while computing my income of that particular head? That is what is the discussion point. I hope this is clear. Now, understand this. There is something called as agreement value. I will simply call it as your sale value. What is this agreement value? Now, since we are talking about something like land or building, you all would be knowing that transactions of land or building have to be registered with the registry office so that it becomes an authenticated transaction, it gets a legal validity, and these are always registered in the form of preparing that agreement. So if I'm selling you my building, I'll prepare a sale deed for my building. If I'm selling you a plot of land, I'll prepare a sale deed of my plot of land, and this sale deed gets registered. Now, whatever value we are showing in that sale deed as our sale price, that is the agreement value, or that is the sale value. So let us use the word agreement value only because that is what is used in the provision also. So short form is AV. Now, there is another value. Please pay attention, which is the stamp value. What is this stamp value? When we get this document registered with the registry office, with the sub-registrar office, which comes under the state jurisdiction, in state, there is a tax called as stamp duty. Now, this stamp duty is applicable on registration of specified documents, and this sale deed of land or building is one such document on which stamp duty is applicable. Now, when I am registering this document, which is a compulsion, I have to pay some stamp duty to the state government. Now, in order to evade tax, both income tax and also stamp duty, what people were doing in the past, they were intentionally showing lower price. So even if their actual sale value is 100, they may be showing, let us say 60, so that for the seller, the income is shown taking 60 rupees as the sale value. For the buyer, who has to bear generally the stamp duty, he will also be paying stamp duty on 60 rupees. So for both, it was a win-win situation. Now, since this was a general practice, government decided to curb this practice by introducing a concept called as stamp value. This is a value which is determined by the Stamp Value Authority, And today, the rule is for the purpose of calculating stamp value, you take your, sorry, for calculating stamp duty, you take your stamp value, compare it with your agreement value, and whichever is higher, you calculate stamp duty. So stamp duty matter is simple. You take higher of these values. Done. So for every area's land or every area's building, which may be flat or shop or anything, there is a predetermined value as per the stamp valuation records, which you can always go and get from there. Now, when we come to income tax said कि we also will be adopting this particular concept. State is doing for collecting their stamp duty. We will adopt this for computing our income. However, here we have slight variation. What is this variation? Let us understand. So please remember the short forms are agreement value, that is your actual sale price. Let me change this word to sale price so there is no confusion. And then you have the stamp value, SV, which is a stamp value determined by the stamp value authorities. Now, what is the rule? If your agreement value is greater than your stamp value. First possibility. So answer is you take agreement value as your value for the purpose of computing income. Whether it is PGBP or whether it is capital gain, answer is same. So for both sections 50C and 43CA, if your agreement value exceeds stamp value, you take the agreement value. Now, this is logical because that is the real price at which I am selling it. So let that price be the price for paying tax. No problem. However, when the stamp value is higher, the law says, wait, stamp value is not your real value. It is a value computed by some authority. So we will not directly ask you to compute your income taking the stamp value. We will give you an opportunity. What is this opportunity? You compute 110% of AV. So whatever is your agreement value, take 110% of that. Now compare this 110% with stamp value. Again, the possibility is now this 110% is higher than stamp value. If 110% is higher than stamp value, again take agreement value only as your income, not income, as the sale price for computing income. But if your stamp value is greater than this 110%, they say take stamp value as your value here for computing PGBP income, or when you are computing capital gain, even under capital gain, you take stamp value as the value for computing your capital gains. So this is what is given in 43CA and even in 50C. This is applicable solely when the transaction is for immovable property, that is land building. Irrespective of which head it is getting covered, the valuation mechanism is same, only there are different sections. Let me take some physical means some illustration. Yes, very good, Priyanshi. Very good. So Priyanshi is saying, ki, sir, this is similar to some other concept which we have studied, right? So Priyanshi has given a correlation. I will not mention what she has said. I want others to apply your minds and tell me with what you are finding this similar. With what we have studied earlier, you are finding this similar. So let me take some illustrations. So there is an agreement value, that is the value which you are showing on your agreement, which is rupees 200. When I go and check the stamp value, my first possibility is I get the stamp value as 189. Second possibility is I am getting the stamp value as 217. Third possibility is I am getting the stamp value as 224. So these are my three examples. So assessable value, sorry, not 224. I'll just, it is 242. Oh, even 224 would have done. Anyways, so now, what is my value as per 43 CA. So when I check 43 CA, taking first case, agreement value, that is the value which I have shown on my agreement, that is 200. And the stamp value as per stamp valuation records is this. One second. Okay. Now, in the first scenario, you compare AV with SV. Now, in my first scenario, AV, which is 200, is greater than my SV, which is 189. So my final value as per 43 CA in the first case will be AV. So where AV is greater, no challenge at all. Second, in the second case, AV is 200 and my stamp value is 217. Now the moment AV is smaller, what they say, compute 110% of AV. Now if I compute 110% of AV, it comes to 220, correct? And my SV is 217. Now I have to compare both these figures, 110% of AV with my SV. Now, originally my AV was smaller. Whenever my AV is smaller, I have to make it 110% and compare with SV. When I compare this 110% AV with SV, I find that now this 110% is greater. Whenever this 110% of AV is greater, I will again take AV as my value. So value will always be either AV or SV. This 110% will never be your value. It is only for comparison. Third possibility, that is this one, where SV is 242. Again, I compare AV 200 with SV 242. Again, AV is smaller. So whenever AV is smaller, you take 110%. I take 110%, it comes to 220. And I compare it with SV, which is 242. Now, despite of making AV 110%, SV is greater. When SV is greater, even by taking 110% of AV, now the answer is the value for the purpose of 43 CA. And in fact, even when you will study 50C for both sections, the answer is same. Now the final answer, the value would be 242. Okay. So first, Priyanshi has mentioned that this concept is similar to something and others have chipped in. So Priyanshi had said, sir, it is similar to the GAV concept of HP. Yes. So that is again confirmed by Anubhav, Almas, even Soumya. Yes, Kevin. Yes, Rajveer. So you are correct. Bharat is saying, sir, in real life, well, we heard stamp paper fraud in, sorry, we heard a stamp paper fraud. Is any relation this concept, sir? See, stamp paper fraud is altogether a different concept. It has nothing to do with this concept. This concept is about stamp duty, for which the valuation is done by the stamp authorities. Yes, the agreement that you make is on the stamp paper. That is the only relation of stamp paper in this case. Priyanshi is asking, sir, why 110% of AV? Nee, so what is the problem, Priyanshi? Means, what is your question when you're asking why 110%? See, if I have to give you a very rude answer and even a crude answer, the answer is Mary Marzi. Who is this saying? Not me. It is the law which is saying. So it is law. If you want to know the logic is this, that see, AV, that is your agreement value, is the real practical value. That is a value at which your transaction is taking place. Now, we all will appreciate that even if the land, let us say the plot of land is same, because it is in the same vicinity, same area, everything is same, still different buyers and sellers may negotiate different value. So AV, which is your real value, can always be different. It may be plus minus depending upon buyer seller interaction and transactions. Stamp value is generally fixed once in a year. So practically stamp value is a theoretical value, it is a deemed value. Now I already gave you the background why this concept was introduced in income tax, because people were evading tax by intentfully showing lower value so that the tax or the profit would be less. Obviously, if you are showing low sale price, by default, the tax would be less because the income which you're reporting would be less. So to avoid this, income tax brought in this concept. When they brought in this concept, they realized one thing, that as I just told you, assessable value is a real life value depending upon the dynamics of uh, demand by buyer, supply by seller. We have studied all that in 11th standard economics, the dynamics of law of supply, law of demand, etc. So it cannot be rigid. AV may be up and down. Nobody will exactly do a transaction at stamp value. It is always depending upon their it is always depending on the demand supply dynamics. Now, in this particular case, if I be very rigid with the concept of taking stamp value only, then it would be defeat the purpose. So they have given you the grace of 10%. Means what? That even if there is a variation in your value, that is your agreement value, and the stamp value up to 10%, that is acceptable, right? In fact, if I have to show you something, here I have written 110 and I have cancelled it out. Why? Because there was a period immediately after COVID when there was unlocking. For some period of time, they had kept this margin up to 20% also. So in that period, even if the difference up to 20% was there, it was acceptable. Means as we made it 110%, what is this meaning? That even if your assessable value is slightly lesser than your stamp value, up to 10%, they are accepting assessable value, means sorry, agreement value. Earlier in a interim period immediately after COVID unlocking, this they had allowed a difference up to 20%. So at that time we were taking 120%. Now that is gone. So I hope I could answer your question. So if you are asking me why 110, this is the answer. So, Bada Priyanshi, over there, we used to add back vacancy rent. This is what we were doing in GAV. So that also increased your AR. Similar logic we are doing here. Here, we do not have anything like vacancy. So they have given you that 10% margin. So that much they are accepting the variation. If your variation is more than 10%, they will say that, okay, if you are showing so much low value, which is even after adding 10%, your AV is less. So they are indirectly, they are saying that you are underreporting your income. So let me take stamp. Fine. This is the logic. Kevin is saying, sir, for the purpose of this section, does AV includes machinery? No, but why machinery is included? It is only including land and building. If you are selling machinery along with plant, anyways, law says you have to value both separately. Please understand this. Plant and machinery are two different assets. Yes, I know in accounts we always write plant and machinery together. But if your building is such that it is independent of machinery, you always show it as an independent asset. In that particular case, AV will not include the value of machinery. If it is such that plant and machinery are indispensable, that is, they cannot be separated, it is one only. In that particular case, better it is more treated like an independent asset, and you take the AV and even the SV of that independent asset, which is plant and machinery combined. I hope this is clear. Fine. Generally, in that case, it is considered more as a machinery. So you may not even get a stamp value for that. Is this clear? Fine. So students, this is what is this section 43CA, which is equivalent to 50C. And this section has only implications theoretically. What I mean by theoretically is that this section, if asked in the question, will not be asked as a theory question. It will be asked as a MCQ question. So you will be, I'm sure you all are knowing that we have an MCQ question in which you are given different questions with 4 options. One of the questions will be this, where any similar type of example would be created with some names of persons, with some dates, and with some values. So you have to simply compare the agreement value with the stamp value. If your agreement value is higher, agreement value is the answer. Generally, the agreement value would be lower in the sum generally. If it is lower, make it 110% and again compare it with stamp value. Now, if this 110% is higher, take the original agreement value as your answer. But if still stamp value is higher, you take stamp value as the answer. Is this fine? Now, what will be more interesting to note is something else in this provision. That something else is the data. Now you will say, sir, what is this? I'll give you an example. And this is generally how your case study questions would be. So let us say Anand sold his flat and Anand, let me make it clear. 1 second. Anand, a developer, sold flat in a scheme. Scheme means a project where he has constructed multiple flats. He sold a flat. The buyer agreed for, let us say, rupees 1 crore on 14th of October 2024 and gave a token of rupees 10 lakhs. So buyer agreed, means he gave confirmation that yes, I am ready to buy your flat. The price agreed was 1 crore and all this happened on 14th October. Now, generally in case of real estate, what happens, since the valuations are high, many times the buyer wants to arrange some loan. So what buyer does is he says that, okay, I'm booking your flat. So for booking, the buyer gives you a token. And then the buyer goes looking out for banks and different financial options. And once the finance is arranged, then the deal is completed. Now what is happening? The sale deed, that is a final document, is registered on 19th March 2025. So by this time, between this gap of 5-6 months, the buyer arranged the loan and the deal was completed. Now, what is the challenge or what is the important provision over here? The provision is that your agreement value is freezed. Your agreement value is 1 crore, no doubt at all. But in the sum, they will give you stamp value, one for 14th of October and another for 19th of March. As I said, stamp value is revised once in a year. Let us say here, the stamp value is revised on 1st of January. So here, the state government is revising the stamp value on 1st of January. Now, the difference is, here it is saying the stamp value here was 1 crore 2 lakhs on this date. And here, the stamp value is 1 crore 22 lakhs. So both dates have different stamp values. Now you can understand the relevance of this date. What is the relevance? I know now the provision that I have to compare my agreement value with stamp value and then apply this 110% and all and find out the answer. But now the question is, I should compare it with stamp value of which date? Because depending upon which stamp value I'm comparing, my answer can be totally different. If I'm comparing it with this stamp value, that is of 14th of October, I'm sure you'll know that your answer will be 1 crore, the final answer. But if you're comparing it with this stamp value, which is in March, I'm sure you know that your answer will be 1.22 CR. So the answer will be changing drastically. The final sale value that you have to take will be different, and hence the net profit and the final tax will be different. So it is very important to determine which date's stamp value has to be taken. Now the law has defined this also in 43CA and 50C both. What it says, we will take the stamp value of the booking date. See, there are two dates. One is the date of booking. One is the date of final sale deed when your final agreement is registered. And there is a very good possibility that in between these two dates, the government has revised the stamp value. Now, the law says we will be taking the date of booking. But the point is, On the date of booking, the sale deed has not happened. So date of booking is simply a date where we both met, the developer and the buyer met. We agreed between ourselves something. You gave me some token and we confirmed this transaction. So date of booking is a date of confirmation. But we all know that all laws, especially taxation laws, go by documents because documents are the evidence that this transaction has happened. Now, document which is registered is sale deed, which is getting registered in March. Now, in this particular case, how to determine which date is the relevant date for taking stamp value? The law says we will take your date of booking because actually the transaction happened that day. But what is the proof that on the date of booking, whatever you are saying, in my example, 14th October, actually you all have agreed for this transaction? The answer is the token. But again, what is the proof that genuinely on that day token was paid? So they have made this provision. We will accept your booking date if the token, whatever you are saying, was paid to confirm this transaction, is paid either by account pay check or account pay draft or any of the electronic mediums. I hope you remember this. We studied this in one of our restriction provisions where they said that where the expenses exceeds 10,000, compulsorily the payment should be by account pay check or draft or any electronic medium. Same rule is given over here. Okay, I am ready to take your date of booking for determining the stamp value, provided I should get some concrete proof that that was actually the date of booking. And what is the proof? The proof is you booked, how you book by making payment of token. So they are saying that I will take that date provided the token was paid by account pay check, account pay draft, RTGS, NEFT, UPI, BEAM, or any of the approved online medium. If you cannot give me this, it means you are saying I paid it in cash or I gave it by way of bearer check. I will not accept date of booking. In that case, I will take the sale date because for that I am having a documentary proof. So the answer is which date is relevant for taking the stamp value. First preference is your date of booking, the date on which you all agreed, provided the token was paid as per this medium. If not, then the final sale deed date for which you have the agreement, that is a sale deed, where the date is already there on that sale deed, you will take that date. I hope this is understood and clear to everyone. Students, okay. Others, please confirm. Yes, students. Okay, good. Perfect. Fine. So students, this is 43CA. So again, coming back. So these are the credit side provisions which you have to keep in mind when you are computing PGBP income, right? Then we come to the debit side provisions, and I have broken up the debit side provisions into two parts. First is every expense should satisfy the golden rules or it should be an exception. Then after you have satisfied the golden rule and you claim that yes, my expenses are eligible, still the next step comes is you have to check if there are any restrictions or disallowances. Now, what are these golden rules? Broadly, four golden rules. Expenses should be related to business. It should be revenue in nature. It should be of current year and it should not be an offense. What are the exceptions? Few expenses, even if not related to business, will be allowed. Family planning expenses, but only for companies. Scientific research. Now, scientific has two types. One is you are doing it in-house or you are making payment to outsider. Now, if it is outsider, it may be related or it may not be related. In both cases, you get deduction. That is this point. But when you are doing in-house research, that is, you are doing research by yourself, then compulsorily the expenses has to be related to your business. So now see, as we are proceeding, I'm giving you some more finer details of each provision. Now, we are talking about this point here. So here, even if the expense is not related, still, if this outside person is an approved what scientific research association, college, university, organization, laboratory, etc. In that particular case, I will give you this deduction, even though the research done by them is not related to your business, but it is in national interest. Remember one thing, this is not allowed when you are in the new regime, which is the default regime. Second is where you are making donations. If in the question they have simply mentioned in the P&L debit side donations, you don't take deduction. If they have mentioned donation falling under one of these sections, again, you don't take deduction in PGBP. Yes, you are allowed deduction in another chapter, but that is not concerning us right now in PGP. While computing PGP income, you don't get deduction. Then only if the donations are specified as donation under any of the sections of 35, and 35 has multiple sections. So if any section of 35 they have specified the donation, only then you are getting this deduction under the PGBP head. Giving you examples of two prominent ones, agriculture extension related donation or skill development related donations. These may not be related to your business because you are in none of this. Still, since all this is a national cause, the law says we will allow you deduction. Again, expenses should be revenue in nature. Again, the exception to this is if family planning, obviously we are talking about companies because only they get this deduction. So if you're a company, revenue expenses will be allowed full immediately. Capital expenses will be allowed in 5 installments spread over 5 years. As far as scientific research is concerned, when you're doing in-house, which has to be related, keep this in mind. Here again, capital expenses like bringing some machinery for research or setting up some laboratory or making some type of structural expenses, which is a capital expense, will be allowed as deduction. Third is when you are engaged in any specified business, which is specified under section 35 AD, capital expenses incurred by such businesses are also allowed. So these are the three exceptions where capital expenses are allowed under PGBP. In all other cases, not allowed. Next requirement, expenses should pertain to the current year. So it should neither be of past nor of future. Exception to this is only in one case future expenses are allowed. That is where we have created provision. Condition is you should satisfy the conditions which we study in 40A7 below. Next, past expenses. When you are claiming capital family planning expenses, which is allowed in 5 installments. So the expenses are of past, but you are still claiming it in 5 years. That is how it is exception to our rule. Similarly, you did some scientific research even before commencement of business, which is preliminary. They are saying preliminary up to past 3 years, that is before commencement of business, up to past 3 years, whatever research you have done, you can claim it in the year of commencement full. Next, other general preliminary expenses, which is covered in 35D section, or expenses on amalgamating or demerging a company, which is covered in DD, or VRS paid to your employees, which is covered under DDA. These are all allowed in 5 installments. So again, you have incurred these in past, but they get continued in future also. Next, you are in mining business. So expenses incurred before commencement of mining business. Preliminary expenses for mining are again allowed. Now here the period is 10 years. Then these two expenses are related to restriction sections. First, expenses of past years, but in that year, either you did not deduct or deposit the TDS, so you did not get the deduction then, you are depositing the TDS now. So the year of deposit of TDS, which is the current year, you get the deduction. But the expenses are pertaining to past year. So this becomes exception to our rule current year. This I have yet to explain because we are yet to deal with that section out. And the fourth is the expenses should not be anything which is illegal, which is forbidden by law. If you incur any such expense, no deduction. Example of such expense for which no deduction is allowed is bribe, payment to underworld, or penalties for offenses like smuggling, tax evasion. What is allowed, because these are not expenses on offenses, is again penalties, but which are during day-to-day operations of business where some mistakes happen, which are not in the nature of offense. Fine. Asta is asking, sir, how capital expenditure of promoting family welfare and scientific research for purpose of dealing with profit or loss on sale or transfer of asset, including. But I did not get your question. You have mixed so many points in one. Can you just ask what is your query? Because you are saying, sir, how capital expenditure of family promotion and scientific research for purpose of dealing with profit or loss on the sale or transfer of asset. I'm not getting your question, Asta. Kindly make it clear to me. If you want, I can unmute you. You can ask me. Who has raised hand? Not see.
Good evening, sir.
Good evening, Beda.
Sir, the capital expenditure on promoting family planning will be treated in the same way as capital expenditure for scientific research for purposes of dealing with the profit or loss on sale or transfer of the asset.
Okay. Understood. So you are talking about something else. We are yet to come to that point. So you are talking about what will happen in future when this asset, which was originally purchased for family planning or for scientific research, is sold. Correct?
Yes, sir.
Don't worry. I'm yet to come on that. We are still on the first stage when you have purchased the asset. So we are talking about that year in which the asset is purchased when you will claim deduction. Right? Now, after using this asset for this scientific research or for family planning, it may happen that after a few years, you may sell this asset because now that asset is no more required. We will deal with that tax treatment later. I'm yet to come to each section individually. So if you have gone through my sheet also, you'll find that below all these, like from here onwards, we have discussed only up to this point. We were going to now discuss these restrictions, and after all these restriction sections, you'll find that we are having independent sections covered, like depreciation, then scientific research, etc. So in that, I will be answering your question. Is it fine, Beda?
Okay, sir.
Yeah, because that is dealing with altogether a different transaction, which will happen later on when you're selling that particular asset, right? So I do not want to mix it right now. Let us go step by step. So we are still in the year of incurrence of this expense.
Okay.
Done? Perfect?
Yes, sir.
Great. Yes. Anybody else? Any doubts or questions? Please feel free to ask. Students, be more involving because the topic, according to me, is very engaging. And I believe that you all should take more interest for both reasons, from the perspective of exams and also most important from the perspective of your profession. Okay, excellent. So it means you'll have escalated in this subject to such an extent that now you're not having much queries. That is really good. Okay. So let me proceed. Now we proceed to the restrictions and disallowances. This we did in the previous lecture only. So first, what is not allowed as deduction is whenever you are making payment of any direct tax, which obviously today is income tax. So if you are making payment of income tax, either of yourself or of any of your employees' perquisite income, so you are providing them perquisites and you're also paying the income tax on that perquisite, which is obviously in the nature of income tax only, you are not allowed deduction. Second, this is what, according to me, is a very important, interesting section, most technical one, I should say. So you are incurring some expense to which TDS provisions apply. It means you are supposed to deduct and deposit the TDS. Now, either you have not deducted or after deduction, you have not deposited. So even if you do one of these mistakes, the deduction for that expenditure will not be allowed. Now here, the point to be noted is that by when latest you should do the deduction. So they have given you the latest time as by the end of this previous year. So please remember, our exams would be covering previous year 2024-25. So this date is freezed. So latest by 31st of March 2025, which is the end of your previous year, you should have deducted the TDS. And what is the last date for depositing this TDS? So the latest by the due date by which you are supposed to file your returns as per section 139(1). Now, what are these due dates? After the end of previous year, like now previous year 24-25 is over. Now in this current financial year, which is now my assessment year, we are doing our tax computation and we will be filing the returns. So for entities who are engaged in international transaction, they are allowed up to this 30th November to file their returns. So let me specify the exact date. It is 30th November 2025. Then for those entities who are liable for getting their books audited, which is called as tax audit, that is audit as per our income tax provisions under this PGBP head, we are going to study this. Or if you are a company, or if you are a partner of such a firm who is liable for tax audit, then for you, the last date for filing your income tax return is 31st October 2025. And for all other assessees who are salaried or who do not have major PGBP income, that is, they are not covered in tax audit, for them, the last date is 31st July 2025. Now, whatever is the last date of your filing returns, one, you have deducted up to 31st March 25, and two, you have deposited this by any of these dates latest. If you do both, you are absolved of this section. You have complied with this section, no disallowances. However, if you miss any one, either you do not deduct by this date or you do not deposit by this date, then this section will disallow that expense for which you have not either deducted or after deduction not deposited the TDS. So students, remember these dates because either the sum can be straightforward. It will simply say that you have not deposited TDS. That's it. But if the sum has to be designed slightly technical, they will specify the dates. They will not say you have not deducted TDS. They will not say you have not deposited TDS. They will say you have deducted TDS. But the date of deduction given would be 4th April 25. Now 31st March 25, 4th April 25 is just a gap of 4 days. But that will change your answer because in terms of this section, you have not complied with the requirement. So at least the requirement was that the deduction should have happened any time during the previous year. So latest by 31st March 25. Even if you are late by 1 day, I will not give you the deduction in this year. Similarly, the last date was any of these dates as applicable. Generally, you can remember this. Majorly, this will be the date applicable to you in the sums majorly. So even if you are late by 1 or 2 days, let us say you have deposited the TDS on this date, just 2 days late. Still, I will not give you deduction in this year because at least for this financial year, you have not complied with the requirement. So students, you have to understand this, that how the section is designed. So the section is designed with a particular timeline. So you have to keep this timeline in mind so that you are able to actually answer the question correctly in the exams. Now, what if I do not comply with this section in terms of the requirement of deduction or after deduction, the deposit? Then the section says we will disallow your expense. Now, how much would be my disallowance? My disallowance will depend upon the nature of my expense. That is whether my expense is a domestic expense or it is an international expense. If the expense is domestic, that is the payment is paid to a resident and it is to be paid in India, then I will only disallow 30% of the expense. But if it is an international payment, that is the payment is either to a non-resident or to any person who is outside India, I will disallow the entire expense. This is what is the restriction. This is what is the disallowance of this section. I hope this is clear. Now, there are two relaxations given. One, what if you fail to deduct this TDS? So you missed the timeline, you did not deduct the TDS. However, the opposite person, that is a person to whom you have made the payment of this income, who is called as the payee. He is honest, she is honest, and he or she has deposited the tax on this income to the government. Obviously, when they are depositing, they are also depositing when they are filing their returns. Now, when they are filing their returns and they are depositing this particular tax, in that particular case, you have to take a proof from them that they have paid this tax. All this they will give, but that will be in the next financial year. Now, the law says you are allowed deduction of this expense, but how? At least in this year, that is when you are doing computation of 24-25, which is your current PY, this expense will get disallowed. But immediately for the next PY, that is when you will be doing the computation in the next financial year for 25-26, in that year, it will get allowed. So the law is saying we will allow you the deduction, but how it is applicable practically, still in the current year, it will be disallowed first, and in the next year, you can take this deduction immediately. Why? Because the assessee has paid tax. So even though you missed to deduct the TDS, but the purpose of this section is fulfilled because the government has got the tax, because the opposite person has paid the tax. So I will give you deduction only deferring it by 1. Second relaxation is you had deducted the TDS, but you failed to deposit it or you deposited it late. Let us say you failed to deposit the TDS. Now again, as per the main section, I will disallow you the deduction, but in the next or subsequent year, whenever you actually deposit this TDS, I will give you the deduction. So this becomes our exception to our golden rule of current year expense. So in both these years, I'm allowing you deduction of some past period in the current year. So this becomes exception to our golden rule. So example of this is the rent expense is of 2022-23. In that year, I failed to deposit the TDS. So I was not allowed the deduction for this rent. Let us say the rent expense was 10 lakhs. Since it is domestic, I was disallowed 30%, that is 3 lakhs in that year, because I failed to deposit the TDS. Now in the current financial year 24-25, I go and deposit the TDS. So this 3 lakhs, which I was disallowed in that year, I will claim deduction in the current year. So in current year 24-25, I will claim deduction for rent of rupees 3 lakhs pertaining to 22-23. So this is how some earlier period expense will get allowed in the current year. Pragya is asking, sir, in third point, if I am the assessee, who is the payer? See, but assessee is the payer. I am the assessee means I am the payer. I am making payment to you. Let us say you are my employee, so I am making payment to you of salary. Let us say somebody else, I have taken loan, so I am paying the interest. So I am the assessee, I am the payer. You all are my payees. Payee is the person who is receiving. Now here, TDS is applicable to me. I am showing this as my expense in my books. I have to claim deduction of these expenses. But when these expenses will be allowed to me, when I have deducted your TDS and deposited. I hope this is clear, Vidam. Next restriction, simple, nothing much technical. What does this next restriction says? It is under section 40 capital A subsection 2. It says that when you are making payment to a specified person who are generally your relatives or your business associates, we don't have a problem. You can make payment to them. It is fine. We will allow you deduction also. But the condition or the point is that whatever payment you are making to them for this expenditure should not exceed the fair market value. So either it can be equal to or less than the fair market value. So let us say I am showing expense of some contract. So I have entered into a contract for some work relating to my business, for which I am showing the expenditure in my books as rupees 2 lakhs. The FMB of this is 2,50,000. No problem. 2 lakhs is fully allowed because I'm claiming lesser expense. But let us say the expense I'm claiming is 3 lakhs and the fair market value is 250. Still, the law will not have a problem if I'm having this expenditure with a neutral person. But the law will have a problem if I'm having this expense with one of these specified persons, that is either my relatives or my associates. Now, when I'm having dealings with them, with my relatives or associates, The law says, fine, now I have a problem. The problem is that I will not allow you deduction of this 3 lakhs. I will allow you deduction up to 250. It means whatever is the difference between the two, whatever is the excess amount you are trying to show as expense, I will disallow that amount. So in this example, 50,000 will be disallowed. Now, if I have to tell you in terms of reconciliation, while doing reconciliation, what you will do is you will add. So all these expenses, what we are talking about, restrictions or disallowance, wherever our answer is that the amount is disallowed, that amount has to be added. I hope this section is also clear to you all. Asta is asking, sir, who will furnish a certificate as a proof? See, Asta, you are talking about the previous section. That is where I failed to deduct TDS, but you, that is the payee, are depositing the tax and you are giving me the proof. You are giving me the proof. You are the pay. What proof you are giving me? You are giving me your income tax computation and income tax return, where in that computation you have shown my payment as your income. You have calculated it under your respective head wherever it will fall, and you have paid the tax on. So this is the proof which you are going to give. What is this proof? Your income tax computation and your income tax returns. Fine, Asta? Understood, na beta? Super. Let us proceed. Another simple expense is, simple section is 40, capital A bracket 9. We all know that as employers, we have to create and we have to make payment to various employee welfare funds, whatever funds they may be, Provident Fund, ESI Fund, Gratuity Fund, so many funds, superannuation fund. There are so many employee related funds. You have studied the names in the salary chapter. Whatever are the names immaterial. What is important is the funds should be recognized. The fund should be approved. If you are making payment to such a fund, which is either unapproved or unrecognized, as an employer, you cannot claim deduction of that expense. So for claiming the expense, your fund, the fund relating to employee, which you as an employer have created and are showing the deposit or payment, has to be approved, has to be recognized. 40, capital A, subsection 3. Now this is an important section, important both because it is slightly lengthy, having some conditions, some ifs and buts. Second, important because it again has a important relevance in exams. Majority questions. One is the TDS adjustment that they will have, another this adjustment that they will commonly have. Now, what is this point? Whenever you are showing any expense and the expense pertain to a transaction in a day, then the payment for that transaction, if it is exceeding 10,000, then only this section applies. 1 second, students. Yes. So this section will apply only where the payment exceeds 10,000 in a day. If the payment is below 10,000, you need not come and check this section. Also, if your payment is in the nature of transport charges, what you call as freight or carriage, in that case, this limit applies only where the amount is 35,000. Sir, the points you have given in this slide in book, all points are not there. And language is also not easy to understand. Don't worry, beta. I'll show you everything from the module also. Don't worry for the language. See, here I'm showing you in simpler language, but I wish that tomorrow we all upgrade to understand the legal language. So don't worry about the language. In fact, we'll do one thing. Instead of going to the book, we'll go to the act. The best thing is studying any legal subject from the bare act, the bare rules. Don't worry, we'll go there. And I assure you, you will understand. Obviously, first let us understand in simpler language, then we'll go to the technical language also. And but yes, we need to understand it technically also. Fine. And it is there somewhere in the book. Maybe it is in so many provisions you may not have been able to locate. Maybe you may not have been even able to read the entire chapter by now. So don't worry. Anywhere it is part and parcel. So where the payment for an expense in a day exceeds 10,000 for any expense and for transport exceeds 35,000, this section applies. This section simply requires that you will get deduction for this. The only condition is please ensure that your payment is either by account paid check or by account paid draft or any of the approved electronic medium, which include all of these. If your payment is by cash or by crossed check or by a bearer check, then the entire payment will be disallowed. Disallowed means in reconciliation you'll add. Now, there is a relaxation in this condition. The relaxation is provided by way of Rule 6DD, which says that the above restriction will not apply for certain payments or certain expenses. It means these expenses you can claim as deduction even though paid in cash, even though of amount running into lakhs also. What are these expenses? First, payment is to government of indirect taxes. Direct taxes we already know are disallowed. So there is no question how you are making payment. It is always disallowed. But indirect taxes, even if you are making payment in cash, no problem, you will get deductions. So where you are making payment of GST, customs duty, it is allowed, even though payment is made in cash or by check or by any of these medium. Second, where you are making payment of interest and the loan is taken from bank, LIC or NBFCs. Now in question, when they want to make the question more technical, more tricky, they will say that this interest is paid to a person or to a partnership firm or to a company who are not bank or LIC or anything. In that case, if you are making payment exceeding 10,000, this section applies. But where the same interest for a loan is paid to a bank or to LIC or NBFC, the restriction does not apply. Even if you go and deposit this interest to the bank in cash, expenses are allowed. Similarly, if the payment has to be made on a day which happens to be a public holiday or there is some strike, or this is again important, where the payment is for an actual produce like some agricultural item, forest item, animal husbandry. Like I give you example of Amul, where they buy milk from farmers. So where the payment is made for any natural produce and you are making payment directly to the first person who is the grower, cultivator of this. So you are buying some farm produce from the farmer. You are buying milk directly from the person who is maintaining the cattle. In that particular case, only there is a relief under 6D. Fine. Now here there is a technical point. What is this technical point? Let us understand. This I purposefully did not explain in previous lecture because I did not want to overburden you with too many technicals. Now what is this point? Now we all know, in fact today we started our discussion with this only, that in PGBP you will be allowed the option to select your method and in 90% sums it will be mercantile. So you are claiming deduction of expenses applying the mercantile rule, which is due basis. Now please pay attention. You are booking the expense on due basis. Let us say the expense is of 23-24 financial year previous year. So in our language it is previous year. Now in that year you have booked these expense. I'll give you a simple example. You have booked purchases. Which year? 23-24. But these are all credit purchases. Now, in 23-24, this section cannot be applied because this section applies only when you make payment, because only then you'll come to know how the payment was made, whether in cash or by account, paycheck, etc. So in 23-24, you only showed the expense. It means the expense was debited in your P&L in 23-24. No payment was made. Obviously, this will be allowed in that year on due basis. The payment is made in the current year 24-25, and let us say they are saying out of purchases rupees 2 lakhs purchases, payment was made in cash. Now, the moment they say that the payment is made in cash or bearer check or a merely cross check, this section 40 capital A bracket 3 triggers. Now, when you check this section, you find out that there is a default under this section, and that is why this amount should be disallowed. Now, interestingly, the expense is of earlier period. So you have already claimed that expense in the earlier period. But the default has happened in the next period. That is when you are making the payment. No problem. You will disallow this expense in the current year. It means in your reconciliation, you have to add, taking section 43 as the basis, as the reason. So you will disallow this expense, showing 43, 40A's 3 bracket 3, sorry, not 43, 40A bracket 3. And you will say it is disallowed because the payment is made in the current year exceeding 10,000 and not satisfying the condition. So this is again an interesting point relating to this section. Then coming to 48.7, which is relating to gratuity. If your employee has retired in the current year, this section does not apply because the gratuity is always allowed. Whether it is paid, outstanding provision makes no difference, because once the employee is retiring in the current year, it means the employee's gratuity is a current year cost. So it is allowed, whether it is outstanding, paid, provision, etc. But where the employee is retiring not in this year, in some future year, then by default, today what gratuity you are showing will only be shown as a provision of some future year expense. And the moment you are showing any future year expense, the first rule is it is disallowed. However, there is a relaxation, or there is a condition which, if you satisfy, this will be allowed. So what is this? You are creating a provision in books, fine. Along with this, do one thing, deposit this amount in approved gratuity fund. So as you have provident fund, as you have ESI funds, open a gratuity fund, ensure that it is approved, and deposit this amount in the gratuity fund. I'll give you the deduction. So this is the only case where a future year expense like provision, which is for gratuity, will be allowed as deduction with a condition that you have deposited this gratuity in approved gratuity fund. Now coming to the last section, which is yet to be discussed. We did not discuss this in the previous section because it was coming to the close of the lecture and it was slightly where you need to pay attention to. So I did not want to overburden. So let us discuss this section, which is our last restriction. Yes, Anubhav, default of any of these section means you are not complying with the provisions of this section, and then the expenses are disallowed. Fine. Now the section is section 43B. This section applies only when you are following the mercantile method of accounting. So I am calling you as a mercantile assessee. It means you are not following the cash basis. Now, what is so special about mercantile assessee? If you are a mercantile assessee, your trading P&L will be all on due basis. So your expenses are also booked on due basis, means even if payment is not made, makes no difference. And even your revenue is booked on due basis, whether received or not. That is what is mercantile. That is what is due. Now, commonly, the expenses that we find in trading P&L may not be paid in that year because many of them are on due basis. Many of them are on credit basis. You will be paying it in the next year. Fine. Income tax says this is what is mercantile. Once I'm allowing you mercantile system, so I'm allowing you all these expenses. So you can claim the deduction on due basis. Fine. However, 43B says you claim all other expenses on due basis, that is for which you have not made payment, we are okay. But for these 6 expenses, not the 7th one first, only first 6, I will allow you deduction if, even though you have shown the expense as due basis, but they are actually paid by when? They are actually paid by the due date of your filing returns, which we studied in the TDS section also. So let us say your due date is 31st October 2025. Now, I will allow you deduction of these expenses if you have actually paid them by 31st of October 2025, which is your due date of filing returns. It means in your trading and P&L, these expenses are appearing as outstanding. No problem. We are okay with all expenses being outstanding. But these 6 expenses, even if they are outstanding in P&L, which is up to 31st March, it is still okay. But after 31st March and between your due date of filing of returns, you should actually pay it. In other words, if these expenses are outstanding even on this date, then in this current year, I will disallow. So, in short, even though you are mercantile assessee, following mercantile system means expenses on due basis should be allowed to you, fine. But these 6 expenses will be allowed if you pay them at least by the due date of filing of returns, which I'm taking, for example, as 31st of October. So in the question, if they are saying that this expense is not paid up to filing of returns, or let us say your expense was 1 lakh, you have paid 40,000, so 60,000 is still outstanding. I will disallow that 60,000 and again disallowing that. But this rule is not applicable for all. It is applicable only for these specified expenses. So you need to learn this list. What are those specified expenses? Let us see. First is payment to government of taxes. Again, which taxes? Only indirect, because direct is anyways disallowed. Second is again payment of interest to loans, interest on loans to banks, NBFCs, LIC. Third, bonus commission payable to employees. Leave salary payable to employees. Your contribution to employees welfare fund. And last, any payment which you need to make to Indian Railways. Why? Because you are using their assets. Now, big companies, they use railways for transportation of their goods. They use railway stations, they use the railway wagons, they hire it entirely. So they need to pay to railways for using the railway assets. So any of these 6 expenses, if you keep them outstanding, even beyond 31st of March, it is okay. But ensure that it is getting paid by due date of filing of your returns. Then we allow it in this year. If you do not pay it, then we will disallow it in this year. But don't worry, these expenses will be allowed in the year in which you paid. So again, taking example, let us say GST of financial year 21-22 rupees 1,26,000 was outstanding. That you come and pay in the current year, that is 24-25. So expenses of 21-22, at that time maybe you did not have money to pay, you kept it outstanding. That year, definitely this amount is disallowed because we did not comply with 43B, where this expense is covered. This is our first expense of 43B. You come and pay it in the current year. I will give you deduction now. Again, this becomes our exception to the golden rule that the expense should pertain to current year. Because again, here what is happening? Your expenses of some earlier year, you are getting the deduction in the current year. So it is past year's expense. Deduction allowed in the current year. Fine. Now, coming to the seventh item. Why I'm keeping it separate? These are having slightly different condition. Now, what is the seventh item? You have done some transaction with a MSME, medium and small enterprise. If you have done any transaction with a MSME, under the MSME law, the rule is that if you have contracted with them saying that you will make payment to them in 10 days, 15 days, 20 days, etc., you should make payment within that day. I repeat, when you are doing transaction with MSME, you should make payment to them within the due date in your MSME agreement. Right? Now, maximum, how much this can be? It can be maximum up to 45 days if it is written in the agreement. If nothing is written in the agreement, maximum 15 days. This is mentioned in section 55 of the MSME Development Act. So simply to ensure that MSME has proper funds, this particular section 15 of MSME requires that you make payment to the MSME within the prescribed time limit. What is the prescribed time limit? It is the time limit mentioned in their agreement, which can be up to maximum 45 days if provided that type of time limit is written. And generally, people are writing that I will make payment to MSME within 45 days. Okay. If nothing is written in the agreement, if you have not made any agreement with the MSME, then maximum within 15 days, you should have made payment. Now, point is, if the payment is for MSME, then the rule is you have to follow this stricter deadlines of 45 days and 15 days. And here, the due date rule, that is, you can make payment up to the filing of returns, that is not applicable. That is why I kept the 7 points separate. So for the first 6 points, even if you make payment up to 31st October, it is fine. But for making payment to MSME, the rule is your payment to MSME should be strictly within the time limit as per the MSME Development Act section 15. The time limit is maximum 45 days or up to 45 days if some time limit is written in their contract, which cannot be exceeding 45 days. And if nothing is mentioned in the contract, you have not entered into any contract with the MSME, then up to maximum 15 days you have to make the payment. If you do that, you get the deduction now. If you don't do it, you don't get deduction now, you'll get deduction again in future whenever you make. Now, what is important for MSME is you have to remember that our last date for the financial year is 31st March 25. So what you have to check is that if there is any payment for MSME, either it has to be made up to this 45 days or 15 days timeline, as I just explained, or latest by the last date of your financial year, then you will get deduction in the current financial year, for which we are going to solve sums in our exam, that is previous year 24-25. So either the payment is made up to 31st of March, that is the last date of the financial year, or within this time limit of 45 days or 15 days as is applicable. If the payment is made within this timeline, deduction is allowed in this financial year. If the payment is made beyond this timeline, the deduction will be allowed. This is not a permanent disallowance, but it will be allowed in the next financial year whenever you are making this payment. So this is what is the restriction for MSME. So for MSME, there is a slight difference, and for remaining 6, there is a common condition. This is the end of all restrictions. In fact, this is the end of 90% provisions of PGBP. Still 10-15% provisions. What are those 10-15? like we have to study 35 AD business, what are covered. We have to go to details of depreciation computation. Those are there. But broadly, majority provisions concerning computation of PGP income are over, including this final one. Yes, we need to go to more fine prints of these sections to understand it in detail, but in general, they are over. Fine. Yes, Dhanush, I'll be giving break. Don't worry. I understand it is technical. Continuously listening to technical is something heavy. I understand. Anyways, I'm giving break. Don't worry. So I hope things are clear. We take 10 minutes break. It is 7:35 as per my time. We connect 7:45. Fine, students? Let us start. Now, on the screen, you can see a practical sheet. I'll be sharing this today, uploading it later. Now, in this sheet, we will be restricting ourselves only to finding PGBP income, though this can also act as a comprehensive sum where you can compute all the incomes. But for the time being, we'll go step by step. With these sums, we'll first understand how to compute PGBP income from the given set of data. And then in the later part, we will also study how to compute the total income. I'll just go through. There was some chat. Yes, Asta is saying, sir, in case of MSME, her question is payment made up to 31st March or the timelines or 15 or 45 days, whichever is later. Yes, beta. So if the timeline of 15 or 45 days have ended earlier, then up to 31st March. If they have not ended up to 31st March, then whenever they are ending, so whichever is later. Perfect. Now, let us take up these sums and let us now compute your PGBP income with the help of the data given. These are, you can say, slightly simpler. Simpler means I have not yet gone into much technicalities at the same time immediately. We'll upgrade ourselves step by step. So firstly, now these sums will cover different provisions that we have studied till now. First, starting with question number 1. So following is the profit and loss account of Miss Pradnya. Now, you have on the debit side certain line items, as you can see. On the credit side, you have certain line items. And then you are also given some adjustments below. With the help of all this, we will be only restricting ourselves to computing PGBP income, which is asked in the question. So we have to calculate taxable income of Pradnya under the head PGBP. Now, even you'll get this sum. It is not necessary that always it has to be a comprehensive sum only. So let us solve this sum. Now see, when it is only PGBP sum, then my main answer itself is computation of PGBP income. So I will say computation of PGBP income. This is my main answer. So whatever is the question number, let us say it is question 1. Then it is of Miss Pradnya. And it is for the previous year, 24-25, assessment year 25-26. Fine. Okay. Now, as we all know, the format of PGBP income is you start with the net profit or loss as per accounts or your financial books. And then in this, we add or subtract certain items. So what is my net profit or loss? It is 213. Now, I will study this entire example and I will identify what items I have to either add or subtract. Those of you who feel that you can solve it by yourself, you need not wait for me. You can start at least marking what things you will add or subtract. Now, before I go to each line items, what I do is I just go through my adjustment and I check adjustments are relating to what. So first adjustment is relating to salary. So I'm just marking one here. Another is repairs. So repairs is here. Allowable amount of depreciation. Third adjustment is for depreciation. Administrative expenses. 4 is for administrative expenses. Sundry receipts. 5 is for sundry receipts. An expense of 9,000 eligible for deduction under 35 is not recorded. So anyways, you will not find it in the P&L. Okay. So I've marked all the items. Let me start. Let us start from the credit side. They have started with GP. It means they have prepared the trading account above, which they have not given the details. Fine. GP part of PGP, yes. Interest on FD, it is part of other sources. Dividend is other sources. Profit on sale of shares is CG. Salary received is part of salary chapter. And gift received from friend is part of other sources. So I've identified what are my incomes not pertaining to PGP head. And for all these, I have to simply subtract. So without doing anything else, I have to simply subtract all these items. Correct? I hope that is clear. So all these items which are incomes of some other head, not of PGBP, already credited to your P&L. This we have to simply subtract when we are doing the reconciliation. I hope now you all know this reconciliation quite well. Now there is one item, sundry receipts. Firstly, had there been no adjustment, let us talk about this first. Had there been no adjustment, I would have considered it as part of PGBP. Because if you remember, I had mentioned that direct and indirect receipts relating to business will come under the head business only. Sundry receipts, miscellaneous receipts, other receipts, if nothing is specified, we are assuming it is some nominal receipt relating to business head only. Here, they have given some adjustments, so I'll now look at this in the light of the adjustment. Now, whatever adjustment I will be covering, I'll put a tick so that I will understand that this adjustment is taken care of. So sundry receipts relate to sale of scrap arising from business process. So they've just clarified what this sundry receipt is. They are saying it is relating to sale of scrap. Now, since this sale of scrap is relating to business, that it is a business receipt, it will come in the head PGBP. So out of the entire P&L credit side, these are the two items. One is GP, one is the sundry receipts. Both are fully covered under the head PGBP. We have to do nothing in my reconciliation. Is this fine? So this is relating to the credit side. Now we come to the debit side. First item, salary. Again, had there been no adjustment, related to business, yes. Current year, yes. Revenue, yes. Offense, no. All conditions satisfied, I would have taken it as deduction in PGBP fully. However, since there is an adjustment, now I'll go through the adjustment first. Salary includes 3,000 paid to a domestic servant. Now, in my salary, out of the total salary, 3,000 is paid to domestic servant, which becomes my personal expense. And whatever is personal cannot be treated as business. Hence, out of 40,000, 3,000 is not related to business. So 3,000 will be disallowed as per PGBP provisions. Now, this amount of 40,000 is already including this 3,000. So 3,000 amount is already debited to P&L. It is debited, but not coming in PGBP. So for the purpose of reconciliation, I'll have to add that 3,000. So out of 40, 37 is okay. We don't have to do any adjustment for 37 in the reconciliation. But for this 3,000 in the reconciliation, I will add. Second. The second part, second one is advertisement. Now there is no adjustment given for advertisement. Check the 4 rules. Is it related to business? Yes. Current year, yes. Revenue, yes. Offense, no. Fully allowed. No adjustment required. Nothing doing in reconciliation. Repairs and insurance. Had there been no adjustment, again same, related to business. Yes. Current year, yes. Revenue, yes. Offense, no. We would have claimed the full deduction. There is some adjustment. We'll read the adjustment, and in the light of the adjustment, we'll take the final call. What does the adjustment says? It includes 3,500 repair of my residential house. Now this is important. If this is repairs of my residential house, definitely it has no concern with business. Again, it becomes my personal expense. It will not come in the business head. So what I will have to do is, it is again debited. It is included in this total 32,000. This 3,500 is included. But I cannot take deduction under PGBP because it is not a business expense. So debited to P&L, but not allowed as deduction under PGBP. So add. Right now, students, I hope you are understanding this. Perfect. See, the immediate next sum, I am not going to touch. You have to solve it yourself. Correct? Okay. Depreciation. This will do simply, students, what we discussed in the last lecture. I don't remember who suggested this. Since you will be given a separate amount of income tax below, we will simply do what? We will add entire amount of depreciation in P&L, and we will deduct entire amount of depreciation given in adjustment. So simply entire P&L depreciation add and entire income tax depreciation less. Other way around, what I prefer is taking the difference and then deciding add or less. But instead of doing that, let us do the simple approach, which is also followed in our modules format. So entire depreciation of P&L add, entire depreciation of income tax less. Next item, rent rates taxes. Dhanush, beta, please pay attention. You will get to know because in every line item, we are going to repeat that. Now again, for this item, rent rates and taxes, check whether it is related to business, assuming yes, because nothing is given. Current year, revenue, and it is not an offense. So it is allowed fully doing nothing. Personal tax. Now the name itself suggests that it is not an expense of business, but debited to P&L. What I will do is I will not allow it under PGP head, and whatever is debited to P&L but not allowed under PGP, adjustment is you have to add in the reconciliation. GST amount related to business, yes. Current year, yes. Revenue, yes. Offense, no. It is fully allowed, no adjustment required. Legal charges related to business, yes. Current year, yes. Offense, no. And revenue, yes. No adjustment required. Audit fees, same. Customs duty, same. Because again, both these expenses are related to business. Current year, revenue nature, not an offense. Allowed. Next is loss on sale of machinery. This is a capital gain loss. Because when you're selling machinery, even though the machinery is used for business, but machinery is used in business as an asset. It is not my stock in trade. So any profit or loss arising on my business assets also will go to the capital gain chapter. So in PGBP, this loss is not allowed as deduction. Now same, it is debited to P&L, but not allowed as deduction in PGBP. So I have to add it in the reconciliation statement. Again, interest on capital, add. Why add? See, it is not interest on loan. It is interest on capital, and this sum is of proprietor. Now, proprietor paying interest to own self is not allowed as deduction because it is just taking money from one pocket to another. There is no expense. Even in accounts do not recognize this as expense. So add. Bad debts related to business, yes. Current year, yes. Revenue, yes. Offense, no. Fully allowed, no adjustment required. Now, the only point left is administration. Had there been no adjustment, we apply the 4 rules. Is it related to business? Yes. Revenue, yes. Current year, yes. Offense, no. We would have taken the full deduction. However, let us check it in the light of the adjustment. So administrative include 10,500 disallowed under 40 clause A means you have not deducted the TDS or not deposited, whatever it is. So 10,500 is disallowed. So what I have to do? Out of this administration expense, 10,500 is disallowed. Now it is already debited in my P&L. What is debited to P&L but not allowed in PGBP, the effect in reconciliation is add. Now, after all these adjustments, sixth is left out. What is sixth? It is an expense, 9,000. It is relating to what? It is relating to deduction under 35. So it may be scientific research or some donation under 35. And most important, it is not recorded in P&L. As we can see, P&L is not showing this expense. Now, most important point. Since it is an expense which is allowable under section 35, it means the PGBP head is allowing deduction of this. Important. In this example, the expense is not debited to P&L. Something which is not debited to P&L but allowed as deduction In computing PGBP income, what you have to do is in reconciliation, you have to subtract that amount. So I will subtract this in the reconciliation statement. I hope this entire thing is clear. Asta, what you are asking, GST payable will be what? It is already allowed as deduction. I have mentioned here. See GST, even if it is GST payable, outstanding, it will be allowed, provided you have to assume, because GST is covered in 43B, which is our last section which we studied today. You assume that it is paid before filing of your returns. That is what we will assume if the sum says GST is payable. See, these amounts are payable on 31st of March because we prepare books of accounts as on 31st of March. So if nothing is mentioned in the adjustment below, you will make an assumption, you write a note. It is assumed that the GST payable is actually paid or deposited before filing of returns. Fine. Now, with all this, we start our final presentation. So I have to add certain items. So add salary to domestic servant 3,000. Right? Next item, repairs of residential house 3,500. Then what else? Depreciation and as per accounts. $36,000. Right? Personal tax 9,000. Then loss on sale of machinery 40,000. See, these two I've added because these are personal expense. This anyways, add and less both we are doing. Again, this I've added because this is personal expense. This I'm adding because it is capital gain head related, right? Then interest on capital and in administration 10,500. Administration expenses into bracket this under section 40 clause A. This is already given in the sum. So 10,500. And interest on capital. This is not an expenditure. Why? Because you cannot pay interest to yourself. So interest on capital 7,500 add. Correct. Now we go to the less items. I'm just keeping 2 lines blank by chance there is something left out. I find out later on. So less all these incomes which are pertaining to other heads, interest on FD, dividend, profit on sale of shares. Salary, gift from friend. Now all this is other sources head. This is capital gain head. This is salary head. Again, this is other sources head. Right? Amounts 19, 6, 15, 25. Is left 75. Then my adjustment, there are two things. One is depreciation as per income tax, 42,000. Depre as per income tax rule, 42,000. Correct. And last is expenses, 9,000. Expense allowable under section 35, not debited to P&L, 9,000. Now, after all these items, I'll get my income from PGBP. Now, at this level, you are also expected to write notes. Now, for what you have to write notes? Many times students ask me, sir, for what we have to write notes? Remember one thing, students, this is the thumb rule for any chapter, rather any subject also. You have to write notes justifying or explaining what you have done in the question. So like I have done some additions, I've done some subtractions, but if you can see in every point in the bracket, I have given the justification. Where I need to give some detailed justification, I will write the note. Like in this case, let us say in the question, this GST given is GST payable, right? Now, if it is GST payable, as I was explaining, I will get this deduction, but we just studied section 43B, which says that you have to pay this GST before the due date of filing returns. Now here, as I mentioned, since nothing is given in the question, you have to make this assumption that yes, it is already paid. But if you are making this assumption, you have to write it somewhere. So let us say what Asta was suggesting, what if this GST was payable? So I'm assuming that this question says GST payable. Firstly, it is allowed, yes, but subject to 43B, which we are assuming is satisfied. So this is what I will write here as note. It is assumed that the GST payable is actually deposited before due date of filing returns under section 139(1). So notes are only for clarifying what you have done in the sum. Any subject, any chapter, follow this rule. You are not supposed to write note for each and every. What note you'll write for each and every item? That is why I mentioned it in the bracket itself. Why I'm adding some item, either because it is personal expense, or either because it is some other head expense, or because it is disallowed under some section. But where there is some detailed explanation to be given, or like in this case, I have to make an assumption, I will be writing a note. Correct, students? So this is how our presentation of PGBP head would be. Now in this question, since only PGBP income is required, this is our main answer. Had this been a comprehensive sum, as I was explaining at the start of this chapter itself, this whole working will come as a working note here. We will show it as a working note, giving it some number, working note 1, 2, 3, and my main answer would be the main computation of income, and all these heads would be my adjustments. Sorry, my working notes, right? But since in this question, you are asked the PGP head only as the main question, so this is going to be my presentation. Understood? Clear to all? Is this question also clear? Right? I'm not engaging in using the calculator to find out the final answer. I wish that we solve more number of sums. So I now open this to everyone. You have to solve the next sum by yourself. So if anybody wants, you can take the screenshot of this so that it will be a record with you. Take a screenshot of this, and then now we will go to the next question. Right? Anubhav beta, whatever I'm showing is the final presentation for exams. So you have to do it in the same fashion. When you're writing the answer in the bracket, you will give your justification, right? Chalo. So students, now you have to take up this second question. As you can see on your screen, slightly lengthy, but that is how it is going to be in exams also. I give you roughly 10 minutes. I just want you to give me what will be add, what will be less. That's it. Even if you have not done in writing, that you can do later on, at least you have to give me what is add, what is less. So maybe in your books you can mark it, or somewhere you can just note it, so that when I will discuss with you, you'll give me the final call for everything. Fine? 10 minutes. You all have to solve. Huh? I'm waiting for you all to solve. But whoever requires, take a screenshot of this so that you can zoom it in your screen. If I zoom it now, some people may be on some other thing, then something will be missed out. So I cannot zoom it here. You all take a screenshot and zoom it in your screen when you are solving, right? Somebody has just informed there is no net profit. Students, don't waste your time in calculating net profit. Ignore that. I want you to understand this sum solving principally. So later on, you can compute the net profit, the balancing figure. Right now, you have to just mark add or less. Please be clear. Should we start? चलो भाई. So we have adjustment for depreciation, one, rent rates and taxes, two. Then we have for administration, sundry receipts, administration, three, sundry receipts, four. Then we have for interest on loan, we have for commission, uh, commission, six, and we have advertising and that gets recovered, not included. Okay. Advertisement. Okay. So let us start. GP is part of PGBP, so no adjustment required. It will be there in PGBP computation. Next, commission received. Now, when you are receiving commission, again, if nothing is specified, we will consider it as part and parcel of my business activity. Income arising from business, I will keep it here in PGBP. Sundry receipts. Had nothing been specified in the sum, I would have again kept it here, but there is an adjustment. So we'll go as per the adjustment. It relates to profit or loss on sale of obsolete material. So again, there is an obsolete material. arising in your business. You have sold it because it is not required by your business anymore. So that is what will be again considered as part of PGBP. No adjustment required. Correct? Then you have interest on FD. This is of other sources head, so less. Recovery of loan given to employee, less. In fact, this is a capital receipt because loan recovery is a part of balance sheet. So wrongly it has been put in P&L, so less. Rent received from let out property, it is part of HP. So again, here it is less. So on the credit side, these are the three items for which the adjustment should be less, right? Clear now, students? Now coming to the debit side. Salary, all four conditions satisfied. There is no adjustment also. So it is doing nothing. It is part of PGBP head, doing nothing, correct? Rent rates, if nothing is specified, again you check four conditions, all will be satisfied. It will be allowed as deduction. Here we have to test the requirement given in the notes. So it is note number 2. It includes 8,000 as property tax of let out property. That is for this property. I'll understand that this has to be adjusted in the HP head. It is not relating to our PGBP head. Now anything which is debited to P&L but not allowed as deduction under PGBP, add. But how much amount has to be added? Only the amount which is not allowed, that is 8,000. So here, out of 60, how much I have to disallow, that is 8,000. Correct? Again, commission, if nothing is given, all four conditions satisfied, it should be allowed as deduction in PGBP. However, we have note number 6. It relates to commission for getting a tenant. Okay. So again, this is not related to your PGBP because this commission you paid so that you could get a tenant. So you had hired some agent who got you the tenant for this particular property. So this will not be a business expense. And since it is not a business expense, add. So anything debited to P&L but not allowed as deduction. Why not allowed as deduction? Because it is not a business expense. Add. Advertisement, all four conditions satisfied. So it should be allowed, but there is an adjustment. It says that it includes 25,000 disallowed under 48.3. So it means this advertisement includes some payment which you made in cash or by bearer check, which is of 25,000 and it exceeds 10,000. So this 25 is disallowed. So whatever amount is debited to P&L, but this allowed that you have to add. So out of this 115, 25,000 will be added. Correct? Okay. Next is reserve for future losses. Students, reserve for future losses is not allowed as deduction. There is only one case which is allowed, which is provision for gratuity subject to 48. Otherwise, all things which are reserves are not allowed. Then you have depreciation. Our answer is entire P&L depreciation add. And here, whatever is there, that will be less. So income tax depreciation less and your P&L depreciation add. Then you have legal expense, nothing doing. Legal expense, all four conditions satisfied related to business, current year revenue, not an offense, allowed. Conveyance, if nothing would have been mentioned, we check four conditions, all satisfied, it is allowed. However, here, no, we don't have any conditions, so it is allowed. Stationery allowed, bonus allowed. All these are expenses related to business, current year, revenue, not an offense, fully allowed. Then comes admin expenses, which satisfy the four conditions, but we have some adjustment here, right? What is the adjustment? It includes 12,000, which is disallowed as per 48.2. So maybe you have made payment to some of your related person and it is over and above the fair market value. Up to 12,000 it is excess. So 12,000 is disallowed. So out of admin, my 12,000 will be added because it is debited to P&L but not allowed as deduction. Repairs, nothing is given. All four conditions satisfied, fully allowed. Then comes interest on loan. Had nothing been given, all four conditions satisfied, we would have claimed it as reduction. But now we have to test the condition. It is disallowed under 43B. It means you have not yet paid even up to the date of filing of returns. So this loan interest will be disallowed because 43B condition is not satisfied. So it is already debited to P&L, but not allowed as reduction under PGBP, hence add. Then loss on sale of factory building. This is a CG item. So again, add. Correct. Now in the adjustment, this item we have to subtract, that is depreciation. And there is one more adjustment left. Eighth adjustment. What it says, recovery of bad debts, 21,000, and it is taxable as per 41(4), is not included in P&L. So bad debts recovered. So it is of bad debts is of past year. That year you are allowed as deduction. So now when it is recovered, it is taxable, and they have already mentioned it is taxable as per 41 subsection 4. Now, if it is taxable as per 41 subsection 4, then what is the effect that you will give here? So I want you to give me the effect of this adjustment. Okay, correct Anubhav, correct Smriti. Yes, right Ishan. Correct Astha. Anybody else? No, but it is not disallowed, Kirti. It is an income. So you cannot say it is allowed or disallowed. Still, let us not get into language. You tell me whether add or less. Rajveer, wrong, beta. Correct, Harshada. Yes, Soumya. Simply say add because we are following the reconciliation format. Yes, Rekha. Perfect. So you all are correct. Yes, Pragya. We have to add this amount. Why? See, it is income as per 41. Income means income taxable under PGP, but it is not credited in P&L. So what is not credited in P&L, but it is taxable under the head PGBP. So the adjustment to be done is add. Correct? Understood, students? Yes, Kate, you're right. It is income. Perfect. I'm sure majority of y'all would have got this question right. May not be 100%, it is fine. But even if you've got this 90%, that is commendable. Because this is still your first sum of PGBP. And if you've got this right, even 90%, that is commendable. Right, students? So I'll be immediately uploading this sheet for your reference if you need any. But it is simple. I hope you all have got this. So this is the end of the entire module, right? Arshada is saying, sir, for depreciation amount to be added is 20 or 13. See, beta, whatever is debited to P&L, that you will add. Let me check what was that amount in P&L. It is 20, beta. So whatever is debited to P&L, that you add. What is given in the adjustment as amount as per your calculation of income tax, that is income tax rule, that you will less. So 20 is debited to P&L, that you will add, and 13 is the amount which is as per income tax rules, that is less. Correct? Anubhav, what is this 8,000? I'm not getting, better. Difference of what? Difference of what, beta? So students, I hope the calculations are pretty clear. You all are understanding PGBP thoroughly, right? Soumya is asking, sir, interest on capital, why disallowed? But interest on capital is disallowed because that sum is of proprietor and proprietor paying interest on capital means paying interest to himself or herself. How can it be income or expense? You are having your business in which you have invested capital. Your business is paying you interest again. You and your business are one and the same in proprietorship. So how can you earn any income from yourself, or how can you have an expense with yourself? That is why it is disallowed, because it is not an expense at all. Correct, Soumya? Yes, beta, Anubhav, you can go with the difference method also. But remember one thing, when you are calculating the difference, it may be either add or less depending upon which figure is higher. P&L figure is higher or your income tax depreciation is higher. So that you'll have to test in every question. That is why the easiest part is simply add the P&L amount and subtract the income tax amount. Simple, right? That's it all for me from my side for today, students. Please keep studying, start reading the module. Though the language is difficult, go with that. We have to upgrade ourselves to understanding even the technical language. Thank you. Good night. Bye bye. Take care. Good night, everyone. Yes, sir. Done. Thank you.